Hello dear fellow to my learners, and welcome everyone to our academic and comprehensive guide lectures on more about what is a life insurance, and we'll talk about the retirement accounts. Today, that you will soon know in this video about in the concept of life insurance, we'll deep dive right away now to explore all of the fundamentals of life insurance companies, and here is a sneak peek. You'll discover what is word retirement planning when it comes to life insurance's policy. Clapperboard life insurance in 60 seconds. Life insurance is a contract between you and an insurer. You are the one who pays for premiums, and in return, your loved ones receive a death benefit when you pass away, helping cover expenses like debts, education, or daily living. There are two main types. Term life insurance, affordable, covers you for a set period, 10, 20, 30 years, but doesn't build cash value. Permanent life insurance includes whole life and universal life, lasts your entire life and builds cash value over time. Premiums depend on your age, health, and lifestyle, and policies come with legal terms and exclusions like suicide or fraud. Bottom line, life insurance offers peace of mind and financial protection for those you care about most. Insurance originated in ancient China, where merchants minimized losses during sea trade by sharing risks. This risk-sharing concept laid the foundation for modern insurance, with merchants pooling their resources to compensate for losses incurred during long voyages. The practice of distributing cargo across multiple ships, so if one ship sank, no single merchant would bear the full cost of the loss, was a form of risk-sharing that became fundamental to modern insurance principles. This approach allowed merchants to hedge against the risks of piracy, natural disasters, and other maritime perils, ensuring that trade could continue despite potential losses. Insurance is about pooling risks to reduce individual exposure. This principle is crucial for understanding how insurance companies protect your assets and loved ones. And also, the risk pooling meaning in insurance is the practice of combining the risks of such many individuals or entities into a single pool, allowing for the distribution of potential losses across the group, and this kind of way for method-style approaches and enables the insurance companies to give offer on coverage at a more affordable and quite the predictable rate than if each individuals were to bear their very own risk alone. And anyways, keep mind in note that in the context of insurance, risk sharing typically occurs between the insured and the insurer. The insured pays a premium in exchange for the insurer's promise to cover the costs of certain losses, should they occur. Risk sharing in insurance is a strategy where the potential losses from an uncertain event are distributed among multiple parties, such as insurers, reinsurers, and policyholders. This reduces the financial burden on any single entity and allows for greater capacity to handle larger risks. How risk sharing works. Reinsurance. A primary insurer transfers a portion of its risk to a reinsurer, essentially buying insurance for its own insurance policies. Deductibles and policy excess. Policyholders agree to bear a portion of the cost of a claim, the deductible, before the insurer pays, thus sharing in the risk. Coinsurance. Policyholders share the cost of a claim with the insurer, typically as a percentage. Risk pooling. Multiple individuals or businesses pool their risks together, and losses are shared among the pool. Benefits of risk sharing. Reduced financial impact. By distributing risk, no single party is overwhelmed by a large loss. Increased capacity. Insurers can take on more risk because they have mechanisms to share it. Improved stability. Risk sharing can make businesses and projects more resilient to unexpected events. Lower premiums. In some cases, risk sharing can lead to lower premiums for policyholders as the insurer's risk is reduced. Examples. Health insurance. Employers and employees often share the cost of health insurance premiums. Property insurance. A homeowner may have a deductible on their homeowner's insurance, meaning they pay the first portion of any claim. Reinsurance. Large insurance companies often use reinsurance to protect themselves from catastrophic losses. There are two primary types of life insurance, term and whole. Term life insurance covers specific periods, like 10, 20, or 30 years, and is more affordable but doesn't build cash value. Whole life insurance covers your entire life and includes a savings component that grows over time. Next, key terms include premium, the amount you pay, beneficiary, who receives the payout, policy, the contract, and face amount, the sum payable upon death. Now, let's discuss retirement accounts. Individual retirement accounts, or IRAs, come in two main types, traditional and Roth. A traditional IRA is tax-deferred, with potential tax-deductible contributions and tax-free earnings until withdrawal. A Roth IRA allows you to pay taxes upfront, making qualified withdrawals tax-free. Contributions are made with after-tax dollars, offering a significant advantage in retirement planning. What is a Roth IRA and how do they work? A Roth IRA is an individual retirement account to which you contribute after-tax dollars. While there are no current year tax benefits, your contributions and earnings can grow tax-free, and you can withdraw them tax-free and penalty-free after age 59 and a half and once the account has been open for 5 years. Both traditional and Roth IRAs allow earnings to grow tax-free, making them powerful tools for long-term savings and investment. Everyone faces 4 primary risks: dying too soon, becoming disabled, living too long, and encountering emergencies. Life insurance helps mitigate these risks by providing financial security for dependents and ensuring long-term financial planning. What is the purpose of the long-term planning? Long-term planning refers to creating strategic goals that may take a substantial duration to accomplish. It focuses on achieving objectives set for the projected future. They usually involve several steps and may take a minimum of 1 or 2 years to complete. Insurance companies generate income from premium income and investment revenue. They compute gross premiums by adding a loading fee to the net premium, covering operational expenses and providing a safety margin. There are various types of premiums, including natural, level, and fractional, each with different payment structures and benefits. Term life insurance plans provide a death benefit for a specified period and do not accumulate cash values. Permanent plans offer lifelong coverage and cash value accumulation, with participating plans offering dividends. Understanding these concepts, you can make informed decisions about your financial planning. Thank you for joining us, and stay tuned for more insights on personal finance and insurance.